Hello everybody, my name is Shipra Singh and I welcome you to this video on financial risk management interview questions and answers from CareerRide. FRMs are the professionals who study financial markets and global trends to identify possible risks that could impact a business. The role also expects them to create smart strategies to reduce or manage these risks before they actually lead to any big problems in the business. These professionals can work in positions like risk analyst, credit risk analyst, market risk analyst, operational risk manager, fraud risk analyst, credit scoring analyst, to name a few. The potential employers for them can be the organizations like commercial and investment banks, big four consulting firms, asset management companies, credit rating agencies, regulators like RBI, SEBI, etc. Then fintechs and startups like Razorpay, Cred, Paytm, to name a few. Owing to the growing complexity in global finance, tighter regulations, and the rising importance of risk-based decisions required to be made across the industries, the demand for this position is increasing worldwide. And this is clearly a career that is here to stay for a very long time and offers good prospects also. In today's video, let's see some basic conceptual and practical questions that are commonly asked to the risk management professionals, regardless of the specific domain or employer. So, if you're someone who wants to crack your next interview in financial risk management, do watch the complete video without skipping any parts of it. Ready? Fantastic. Let's start. Question number 1. What is financial risk management? Now see, this seems like a basic opening question, but it's actually a golden opportunity to start building your credibility right from the beginning. To answer this question, you can say, financial risk management is the continuous process of identifying, evaluating, and mitigating potential threats to an individual's or organization's financial health. No business wants to lose money, especially if it is avoidable. And this is where financial risk management steps in, leveraging its structured approach to save the organizations from financial losses. The process starts with identifying the risk, quantifying it, evaluating all possible remedies, developing a strategy, and then implementing the steps and financial instruments that are necessary to minimize the potential losses. Financial risk may arise from a variety of sources, including market fluctuations, credit defaults, liquidity shortage, operational failures, overborrowing, poor financial planning and forecasting, regulatory non-compliance, damage of reputation, external shocks, etc. So, do you notice? I didn't stop just after giving a two-line answer to the question. I have expanded it, provided a little more information about how the process works and what could be the potential reasons for the risk to arise. What this does is, it tells the interviewers that I possess a good subject knowledge and I can structure my thoughts properly. This definitely increases my chances of getting more follow-up questions and progressing to the next stage. So, if you really want to stand out from the crowd, the simplest trick is always try to add more value to your answer. But at the same time, it is very important to know when to put the full stop to your answer. A right balance will definitely take you forward. Great, let's move on to question number 2 now. Tell us a bit about credit risk. Again, a very commonly asked question in the interviews. So, credit risk is the risk that a borrower or the counterparty will fail to repay their obligations or meet their contractual terms. For example, if you lend money to someone, the risk you face is they may not return the money or pay the interest or they may not pay it on time. This someone may be a company or an individual client also. So what is this? This is credit risk. Credit risk is influenced by factors such as creditworthiness of the borrower, the duration and structure of the loan or the bond, the collateral or guarantees involved, and the macroeconomic conditions altogether. And you can measure the credit risk using credit ratings, credit spreads, default probabilities, and ultimately the loss given default. Now, if you want to reduce your credit risk, what would you do? you would diversify the portfolio, ask for collaterals or guarantees, hedge with credit derivatives, or transfer the risk to a third party. So, do you notice this one single simple answer covers almost all the basic details about credit risk which are required at this point of time in the interview, and they definitely increase my chances of moving ahead and standing out of the crowd. You also try to structure your answers in this manner. Moving on to question number 3. What is market risk? Now, to answer this question, you can say market risk is the risk that the value of a financial asset or instrument will fluctuate due to the changes in the market price or rates. For example, if you possess some foreign currency, you run the risk that its value may fall due to the changes in the market conditions, don't you? So, what is this? This is market risk. It can be influenced by factors such as supply and demand, investor sentiment, volatility of the market, liquidity, and macroeconomic events altogether. Some of the commonly used indicators to measure market risk include value at risk, beta, standard deviation, and sensitivity analysis. Fantastic. Let's move on to one of the interviewer's favorite questions now. What is the difference between credit risk and market risk? So, if you are also asked this difference, you can say credit risk is specific to a borrower or a counterparty, while on the other hand, market risk is common to all the participants in that market. Then credit risk is asymmetric. This means there's a limited upside but a large downside potential, which means the profit you earn here would be limited to the interest amount, but the loss can be huge and may include both principal amount and interest. While on the other hand, market risk is symmetric, which means that there's an equal chance of gaining or losing the value. Credit risk is more dependent on the characteristic and behavior of the borrower or the counterparty, while market risk is more dependent on the external factors and events that affect the entire market. Moving on to question number 5. What is value at risk? To answer this question, you can say value at risk is a commonly used risk assessment technique that estimates the maximum potential loss an asset, portfolio, or firm might incur over a specified period of time at a given confidence level. Now, before we move ahead, for those of you who need more clarity, confidence level here means degree of certainty that the actual loss will not exceed the estimated value at risk. Let's take an example. If I say a one-day value at risk of rupees 10 lakh at 99% confidence, what does this mean? In simple words, it means there's a 99% chance that your losses will not exceed rupees 10 lakh in a day. Question number 6. What is the difference between risk and uncertainty? Again, two very commonly used terms in the world of financial risk management and a very commonly asked question. So, risk is a situation where the outcomes are unknown, but the probabilities are known or can be estimated. And you can quantify this risk with the help of past experiences, data, or statistical models. For example, when you lend money to a client with a known credit score, you know the possible outcomes and their probabilities of occurring. The outcomes are manageable and measurable both in this case. On the other hand, uncertainty is a situation where outcomes and their probabilities both are unknown. You can't measure or predict it. For example, the possibility of a world war breaking out. What is this? This is uncertainty. If you see, the event itself here is unpredictable, and so is its impact. You won't have any data to make the calculations of it happening or not. So you can't find out the probability. Everything is uncertain here again. So what is this? As I said, it is uncertainty. If need be, you can replay this question because this is again a very important question and it is usually asked in the interviews. Great. Let's move on to another interesting question. Question number 7. What is the difference between systematic and unsystematic risk? Now see, unsystematic risk is a risk that is specific to a company or industry, while systematic risk is the risk that affects the entire market or economy. It happens because of external factors. That is why systematic risk is also called as market risk or non-diversifiable risk. Non-diversifiable because everybody in the market is affected. Even if you diversify, you are not going to be able to save yourself. Unsystematic risk is referred to as specific risk, diversifiable risk, because you can reduce the risk here by diversifying your portfolio. It arises because of the factors that are internal to a company. Let me give you an example. If a war breaks out, it affects the entire market. Diversification in this case won't help. So what is this? This is systematic risk. But if a particular company is impacted by something, say there's some harmful ingredient found in its packaged food, only this company will suffer. You can save yourself through diversification in this case. So it is unsystematic risk. Again, a very important question. I would highly recommend that if you have not gotten it properly, please replay this question, but make sure that it is clear to you. And that applies to each and every question that I am discussing here. Moving on to question number 8 now. Differentiate between expected loss and unexpected loss. So now if you see, the terms here are quite self-explanatory. Expected loss is the average loss that you anticipate based on the available data or past experiences. And since the data is available, it means such losses occur frequently and are predictable. And if you are able to anticipate them, you can take action to control or cover them, usually through loans, pricing, reserves or provisions or whatever you may do. Also, if you have incurred this kind of loss in the past also and were able to absorb it, it means these kind of losses are not a threat to your business. For example, a bank expects 1% of its loans to default every year. What would it do? It would plan for it. It would have reserves for it. What is this? This is expected loss. Now just imagine a situation. Unusual situation arises and your loss goes beyond what you had planned for. The extra portion of loss here is called as unexpected loss. It's unpredictable because it happens rarely due to extreme scenarios like a pandemic or financial crisis. Such losses are covered by economic capital or risk capital, and if large enough, they can threaten the solvency of a company. For example, a pandemic breaks out. Businesses shut down. 10% of loans default. You were prepared for 1%. This extra 9% is unexpected loss. And this is where the difference lies, right? Question number 9. Tell us something about risk capacity, risk tolerance and risk appetite. Now, if you look at this diagram, this becomes quite clear. Risk capacity refers to the maximum level of risk an organization can handle without threatening its survival. The risk capacity of an organization depends on things like its financial strength, capital resources, and regulatory requirements, operational environment, obligations to the stakeholders, etc. So, if you see, basically it is how much risk can you afford to take. The second one is risk tolerance. In layman's words, it means how much risk are we okay living with on a regular basis. For example, a bank may tolerate up to 3% loans defaults annually. While its risk capacity may be way higher, but this is what it is okay with. Risk appetite is the overall amount and type of risk the organization is prepared to pursue to achieve its objective. It's a strategic level expression of how much risk the company is willing to take to achieve its objectives. The risk appetite of an organization may be different in different walks of its business. For example, an organization may say, we have zero risk appetite for reputational risk, but a moderate risk appetite for market risk in our trading division. So basically, if you see, risk capacity is what you can bear. Risk tolerance is what you are willing to bear. And risk appetite is what you want to pursue to achieve your goals. Okay, now the follow-up question to this can be, what is risk appetite statement? So a risk appetite statement is a concise, clear and specific statement that is approved by board of directors and communicates the organization's tolerance for a particular type of risk. An example risk appetite statement can be something like, we are willing to take moderate credit and market risk to achieve our strategic goals, but have low tolerance for operational compliance and reputational risks. All risk taking must align with our capital capacity and regulatory obligations. Of course, it won't be so short. This is just to give you an idea, but a risk appetite statement would look something like this. What this statement does is, it works as a foundational document that helps with decision making at all the levels of the organization, because it provides a clear understanding of what level of risk is acceptable now. The main components of a risk appetite statement include type of risk, risk tolerance level, time frame, accountability and specificity. Question number 11. What is stress testing? Now see, as the term itself suggests, stress testing means testing your systems, procedures, operations, etc. under stressful situations that may arise anytime in the future. The way you stress test your car before launching to ensure that it doesn't break down or do something unexpected under extreme conditions, you carry out stress tests also in the financial risk management. In this case, stress testing is performed using computer simulations, running different scenarios. Now, what happens if a company or product fails a stress test? If a company fails a stress test, it may be required to increase its capital reserves or form contingency plans to address the threats. In the banking and financial service industry, some failures result in fines also, or the prohibitions of certain activities altogether, such as paying the dividends, etc. In India, stress testing in the financial sector is primarily governed by the RBI under Basel framework. RBI mandates stress testing as a part of the internal capital adequacy assessment process. Question number 12. What is capital adequacy ratio? So first of all, to begin with, let's see what is capital adequacy. As the term suggests, capital adequacy means having adequate capital. It measures a bank's ability to meet its financial obligations and absorb potential losses by maintaining sufficient capital reserves. This metric is very carefully monitored by the regulators to ensure the stability and soundness of the whole financial system that exists. Now coming to capital adequacy ratio. The capital adequacy ratio expresses how much capital a bank holds compared to its risk-weighted asset base. It is also known as the capital to risk-weighted assets ratio. This ratio is closely watched by regulators to determine a bank's risk of failure. It's used to protect depositors and promote the stability and efficiency of the financial systems around the world. Question number 13. What is model risk? Now again, if you look at the term carefully, you would know the answer yourself. Model risk is a type of risk that occurs when a financial model that is used to measure quantitative information such as firm's market risk or value transactions, and the model itself fails to perform adequately, and it leads to adverse outcomes for the firm. Such errors in the model may arise due to the usage of inaccurate data, programming errors, technical errors and misinterpretation of the model's outputs also. What can you do to reduce this type of a risk? So, model risk can be reduced with model management such as testing, governance policies and independent review also. Question number 14. What are PD, LGD and EAD? Okay, so PD, LGD and EAD are the three most important components used in credit risk management. especially in banking and financial sectors. Let's see them one by one. The first one is PD, that stands for probability of default. It tells you how likely is a borrower to default on a loan within a given period of time, which is usually 1 year. LGD means loss given default, which tells you how much loss you will actually suffer if the borrowers default. It is commonly expressed in percentage. Now coming to EAD, EAD is exposure at default. This is the value the lender is exposed to at the time of default, which means if the borrower defaults today, how much money is actually at risk. And mind it, it is not always the original loan amount. It includes your outstanding principal, accrued interest, fees, and sometimes even undrawn limits that might be used just before the default. All of them together help you calculate the expected loss. Being able to calculate the expected loss allows you to keep appropriate capital reserves aside for yourself. Question number 15 is it possible to completely eliminate the risk? So see, while you can identify, measure, mitigate or transfer the risk, you can't eliminate it completely. Why is this so? This is because the real world situations, economies, markets, geopolitical happenings are difficult to predict accurately and completely. Some or the other unexpected thing would happen all the time, exposing you to newer risks. Secondly, continuous evolution in technology also gives birth to a lot of new risk all the time. So while you can actually reduce the risk, eliminating it altogether is not possible. Okay, so our question number 16 is, what is hedging? Hedging is again a risk management strategy that is used to offset losses in investments by taking an opposite position in a related asset. Let me try to explain it to you with the help of an example. When you insure yourself or your property, basically what are you trying to do here? You're trying to protect yourself against a negative event that may impact your finances. While this doesn't prevent the negative events from happening, it can definitely help you in reducing their impact on your finances. What you also need to note here is the reduction in risk that is provided by hedging typically results in a reduction in potential profits also. Why is this so? This is because hedging requires you to pay money for protection that it provides, which is also known as the premium. Portfolio managers, individual investors and corporations use hedging techniques to reduce their exposure to various risks. In financial markets, however, hedging is not as simple as paying an insurance company a fee every year for coverage. Now, if you see, hedging against investment risk means strategically using financial instruments or marketing strategies to offset the risk of any adverse price movements. Now, if you put it in another way, investors hedge one investment by making a trade in another. Hedging strategies typically involve derivatives such as options and future contracts. I know this has gotten a little lengthy. If need be, please feel free to replay question number 16. This is again a very important question usually asked at the interviews. Make sure that you have gotten it well. Our question number 17 is, what is risk exposure in business? Now again, if you just go by the words, you can understand this very easily. Risk exposure is the quantified potential loss that your business is exposed to into the current or planned business activities. Easy now? The level of risk exposure is usually calculated by multiplying the probability of a risk incident occurring by the amount of potential losses it may cause. Risk exposure in a business is often used to rank the probability of different types of losses happening and to determine which losses are acceptable or which of them are not. These losses might include things like legal liability, property loss or damage, accidents in the factory, changes in the demand, ransom payment to cyber criminals or other activities that could result in a profit or loss for the business. Now, the follow-up question to this can be, what are the different categories of risk exposure? To answer this question, you can say there are two primary categories of risk exposure: pure risk and speculative risk. Pure risk is a risk that you cannot completely foresee or control, such as a natural disaster happening or a global pandemic breaking out that impacts an organization and its workforce. Speculative risk, on the other hand, occurs based on an organization's actions and their subsequent consequences. For example, you may invest in a software platform that gets hacked later on. What is this? This is speculative risk. To manage your risk exposure as an organization, you use techniques and tactics like risk avoidance, risk mitigation, risk transfer, and risk retention. Great. Let's move on to question number 19 now. How do you determine if a risk is acceptable or not? So see, a risk that is within the organization's risk appetite and tolerance levels is considered to be acceptable. What does this mean? This means that taking this particular risk won't threaten the strategic goals, financial stability, or regulatory compliance of the business. The process here starts with clearly defining and establishing your risk criteria, such as your risk tolerance, risk appetite, etc. Then you try to determine the potential sources of risk, its probability and severity. Then you consider the cost of mitigating this risk. And it is based on all this study you decide whether you should accept, mitigate, transfer, or avoid the risk altogether. Our question number 20 is, what is a risk register? Another important question. So see, a risk register is a structured document that records, tracks, and monitors all identified risks in a project, department, or organization. It is an important part of enterprise-wide risk management, including financial risk, and help the institutions stay accountable, compliant, and prepared to deal with them. It includes items like risk ID, description, probability of occurrence, impact, rating, responsible team, mitigation plan, and status. The advantage of having a risk register in place is it helps in prioritizing the risk, promotes accountability, and keeps the whole process transparent and trackable also. Risk registers are often reviewed by the auditors, risk committees, or regulators such as RBI, SEBI, etc. Having these risk registers in place shows that the institution is aware of its financial risk profile and is taking the required actions to deal with them. Okay, now all of us know that the historical data is one of your primary assets in risk management. And the question that may arise from here could be, what are the limitations of using historical data for risk forecasting? So see, risk forecasting, as all of us know, helps us stay prepared to deal with the future events. And as I said, one of the ways to forecast risk is using past data. But this method can't be used alone. Why is it so? This is because, number one, the markets evolve over time. User behaviors change. Regulations change. And everything that happened in the past may not replicate. Going by just that data may make you miss out on newer angles to the problem and newer solutions also. Then secondly, the data may be biased or incomplete depending on how it was collected the last time. This may lead to inaccurate results in the form of under or overestimated risk. Then the past data usually misses out on low probability but high impact events like COVID, natural disasters, major geopolitical shifts, etc. You would notice that such events are either unrepresented or don't have complete data captured. Organizations in such times are busy dealing with the situation rather than collecting the data itself. Relying on such data completely may make your predictions inaccurate. What's better to do in such cases is combine this analysis with expert judgment, stress testing, and forward-looking analysis. With this, let's move on to the last question of this video. What do you know about the Basel Accords? A very, very important question for any financial risk management professional. Pay attention. To answer this question, you can say, the Basel Accords are a series of 3 sequential bank regulation agreements, Basel 1, 2, and 3, set by Basel Committee on Bank Supervision. The basic purpose of the accords is to ensure that the financial institutions maintain enough capital on account to meet their obligations and also absorb any unexpected losses. The first Basel Accord, known as Basel I, was issued in 1988 and focused on the capital adequacy of financial institutions. Under Basel I, banks that operate internationally must maintain capital that is equal to at least 8% of their risk-weighted assets. This ensures that banks hold a certain amount of capital to meet the obligations. The second Basel Accord, called the Revised Capital Framework, but better known as Basel II, served an update to the original accord. The three main areas of its focus are minimum capital requirements, supervisory review of an institution's capital adequacy and internal assessment process, and the effective use of disclosures. The purpose again here is to strengthen the market discipline and encourage sound banking practices, including supervisory review. Together, these areas of focus are known as three pillars. The latest accord, that is Basel III, was agreed upon in November 2010. Basel III requires banks to have a minimum amount of common equity and minimum liquidity ratio also. Now, the interesting thing to note here is Basel III also includes additional requirements for what the accords call systematically important banks, or those financial institutions that we consider too big to fail. Again, a very important question with very high chances of being asked in any financial risk management interview. Make sure that you're prepared to answer this question. So friends, with this we come to the end of this video, and I do plan to get you more videos on risk management. The video for credit risk analyst is already published. You can take a look. The link is available in the description box below. And if you found today's video useful, do give it a thumbs up and share it with your friends also. To make sure that you keep receiving more of such videos, subscribe to the channel now. I'll see you very soon with a new one. Till then, bye-bye and take care.